please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good day and welcome to Halftime Report. It's 12 noon. We're halfway through the trading session. It's a good time to run you through what's going on now. But today we have with us back is Reema Tendulkar after,
6 months.
6 months. Welcome back, Reema.
Well, Nigel, welcome to you and all our viewers. It's great to be back on CNBC TV18. I've missed all of you. But back to the market. So far, things are going pretty well. We're holding on to our morning gains. As we speak, the Nifty and the Sensex are higher by close to about 1% Just quickly pull up the Asian market screen because there the gains are getting piled on. Hang Seng is now in excess of close to about 500-point rally over there, while the Nikkei has surged to a 1.6% gains. For us, it continues to be a lot about the IT names. Tech Mahindra has gone on and hit a fresh 52-week high. ITC is fueling the rally, contributing significantly to the up move today with a gain of about 3%. But Pharma has started slipping a tad bit. So Aurobindo Pharma is off about 3% from the high point of the day. Some softness seen in Cipla. Coal India has been a drag. The company has announced an interim dividend of 16.5 rupees. But I guess the market was expecting a little more, close to about 18 rupees. So over there, some disappointment coming through on the interim dividend announced by the company. But mid-caps and PSU banks continue to be a spot of bother.
That's right, Reema. If you just take a look at it, some of these banks are really selling off as we speak. Andhra Bank was down nearly around 10%. Now it's down nearly around 14%. So keep an eye out on that one. OBC, Allahabad Bank as well. All those banks, they are selling off. In fact, we'll try to pull in a couple of those managements and get their commentary on what's the latest in terms of RBI guidelines and also how's the loan book really shaping up. But things not looking good from the mid-cap space. Frontliners, though, holding well in the green. Cipla is a stock from the frontline index. It's now down close to around 1%. I remember the stock trading mildly in the green. So that one as well is taking a bit of a knock, Reema.
Okay, and not just PSU banks, but even sugar is hurting today. So Bajaj Hindustan, Dwarike Sugar, Balrampur Chini, not so sweet. But here is a CNBC TV18 exclusive now. Anuj Singhal and Sonia Shenoy are in conversation with Shankar Sharma, the co-founder and chief global strategist of First Global. Guys, it's over to you.
Well, thanks a lot. Joining us now is Shankar Sharma, of course, chief strategist at First Global. Shankar, good afternoon. Good to have you on the show. It's been a rough year for the markets.
Sure, thanks.
If you look at the MSCI Asia ex Japan, from the highs it's down quite a bit. But what's interesting is that we have underperformed quite a bit, Shankar. This year, the Indian market is down about 5%, while the global emerging market index is still up about 5%. What do you think is going wrong with the Indian market in 2018?
Well, actually, it's nothing to do with 2018. The problems started in sort of, I would say the seeds of the problem were sown in the early part of 2016, which is when the commodity cycle bottomed out. I've been publicly bullish on oil and other metals and, generally the commodity complex since February, March of 2016. And that is where, problems for India started. Of course, a lot of problems build up over time. They happen on stealth. But really, India got the dividend of a sharp fall in oil for the 2 or 2.5 years preceding that. And that dividend slowly started to get eroded from the lows of oil at $27 or $30. So the underperformance you're seeing now was actually building up. It's not like sudden. And I was of the view that the same oil dividend which gave us a lot of pleasure will give us a lot of pain when it reverses. And it has reversed incrementally. I think India is the most, if you talk, let's say just broad macro. Indian micro is still very good, which I will come to later, but Indian macro amongst emerging markets, or let's say the BRIC pack, appears to be the most worrisome largely because of oil. Because our macros turned for the better only because of oil, because structurally India was still the same. I mean, there was nothing really structurally that changed much, but just that oil came down, so inflation came down, rates came down, household savings started to get channeled in the stock markets, equities became more attractive versus fixed income, etc., etc. We all know that story. That story, to some extent, has been dented because of the rise in oil, the rise in bond yields, the rise in inflation, imposition of the capital gains tax. So the point you're making was in the building, and it has been only accentuated by the recent moves in the budget. But it's not something that is surprising, at least not to me.
Okay, so Shankar, how much of a factor has the LTCG been, the long-term capital gains tax? We've seen a lot of aggressive selling by FIIs, but that was the case all through last year as well, and the Indian market was still going up. So a lot of people are asking that has that imposition of LTCG changed sentiment a bit? Is that largely responsible for the underperformance of Indian market for the last 2 or 3 months?
No, I do not think it is solely responsible for the underperformance. I think it has contributed, but I wouldn't say that that is the large part of the problem. It is a smallish part of the problem. My view on LTCG has been very simple, that yes, there was a case to impose a tax on equity gains. Question was when. India is still, I mean, you don't have to view it as a revenue generation measure. You have to view it that you need people to move away from gold and real estate and even fixed income into a riskier asset class such as equities, which is the way the world has, let's say, the developed markets have moved, where people don't own real estate much, or they don't own much fixed income or gold, and it's largely household wealth is concentrated in equity markets. So if we want to mirror that global trend of moving into riskier capital, then you have to incentivize that move. So the long-term capital gains tax was an incentive. I mean, or rather, the exemption of that was an incentive for people to move away from fixed income and other unorganized forms of saving into an organized form of saving, which would fuel growth. Companies can raise money, etc., etc., etc. You cannot look at it just as a revenue generation exercise. And India is still under-owned in terms of household wealth and equities. So yes, there was a case. Question is when. My view was maybe 10 years later, when maybe 30–40% of savings are in equity markets. Globally, it's, developed countries are like 50%, 70%, 80%. We don't have to wait that long. But when you're, wherever we are right now, you have to give incentive. It's like giving incentive to an industry. You have to give incentive to backward area, industries. You have to give incentives to pharma. You have to give incentive to telecom. You have to give incentives to software. View it as an incentive being given, and to a very nascent industry, which is equity investing. I just view it from that lens. On that lens, there was no justification to do it now, but there was justification to do it at some point in the future. But that's a long way down the road. So yes, it has affected sentiment, but I don't think the underperformance is because of that. I think the underperformance is because of the fact that I think 2 major factors, and I think the overarching one is obviously oil. I think my view on oil is very bullish. It has been very bullish for the last year and a half, and I don't want to sound alarmist. I mean, from an Indian perspective, are you there?
Yes.
Yes, Shankar.
Oh, sorry, no, there was a beep, so I thought I'd lost you. So I don't want to sound alarmist from an Indian perspective, but I wouldn't be surprised if oil goes up another 20, 30, 40% from here over the course of the next month or year. That will be problematic for India, and that is one of the reasons why the market is behaving the way it is. So the market is reading the tea leaves that the macro for India over the next 12 months will be, let's say, more worrisome than the macros are for Brazil or Russia or China. Brazil and Russia are obviously big beneficiaries of the up move in commodities. So, they have done phenomenally well in terms of stock prices. Brazil in the last couple of years in dollar terms has almost, I think, doubled. I mean, I think maybe 80% up. Russia is doing very well. India that way has been a little tepid performer if you look at the Nifty. I mean, over the last 4 years, I think it's about 12.5% return, which is, not worth writing home about in context of an overall global equity bull market.
Sure.
It's only the small caps which have gone up 45% compounded in the last 4 years, which changed the picture for Indian equity returns completely. Otherwise, just looking at the Nifty is nothing worth writing home about the last 3–4 years.
Sure. Shankar, hi, afternoon. 20 or 30% high on oil. I mean, that's going to be gut-wrenching, right, for the macros. But coming back to the markets, give and take everything, it's not even a 10% correction from the top. So what's your view for the rest of the year? Do you think that this is still a correction in an ongoing bull market, or have we started to see the beginning of a bear phase in Indian equities?
No. I don't think there is any bear market in Indian equities, nor is there a bear market in global equities. We kind of forget that markets don't have to just keep going up perennially or even for 6 or 8 months. We will have sharp cutbacks. And then it's just one of those things. I mean, there is nowhere in the market globally, in markets globally, that I see a bubble or I see irrational valuations. I mean, S&P is like 15, 17 times earnings forward. And bear markets don't start when you're looking at those kinds of valuations. So if there is no bear market in emerging markets, there's no bear market in the developed markets, why should India stand out? In my view, the Nifty and the Sensex will underperform global markets. The small cap will vastly outperform the global market. So there are two different markets in India. And just looking at equity returns the last 4 years, it's very apparent. 12% versus 45% compounded. That kind of return diversion has never happened in the history of India. And I've been publicly very bullish for the last 4 years on small caps. And that's been the reason that I've been worried about the macro, but not worried about the micro. So India will not have a bear market. There's no bear market globally. There's no bear market in India. India might lag on the large cap basis relative to emerging or relative to sort of developed markets. But there's no bear market.
Okay, that's good to hear. I'm going to come to stocks in a bit, but before that, I also wanted your view on politics because, you know, it's the biggest talking point now. Is the Modi government losing a bit of its magic? I mean, we are seeing major farmer agitations now. And, you know, this was the big government, you know, the government's key agenda, right? Solving the agrarian crisis. Do you think the 2019 elections are going to be much different from what we saw in 2014? Or is it too premature to view that?
I mean, my view is that, you know, the magic, etc., to be used for politics is misplaced. I mean, I don't believe that politicians can create magic. I mean, I know, you know, the world kind of changed in the last 3-4 years, whether it was the US or even in Europe or in India, when people started to ascribe godliness to, you know, mere mortals. I mean, I've never ascribed godliness to any politician anywhere in the world. They're all human beings. Some of them, you know, do great work. Some of them do not so great work. Some of them do both in the same reign. I mean, Rajiv Gandhi is a good example. Did some great work, but did some terrible things also. So, you know, when people have such huge expectations, which are irrational, disappointment is inevitable. And I've said this at the beginning of the election cycle in 2014, that you're betting, it's just a way out bet, which can only end in disappointment. So whatever you are saying right now, I mean, I'm not surprised at that. It's just like a management coming out and you believe blindly in that without analysis. So you will have, you know, some degree of disappointment. Even though they have tried well, they have done whatever they were supposed to do to some extent, you will still come away saying, hey, you know, it could have been better. So I don't pay much attention to, you know, all these sentiments around politics of India, for that matter, rest of the world. But yes, 2019 will be interesting. I mean, obviously, the kind of numbers you saw in 2014, you know, it was like, you know, absolute, you know, dream run for the ruling coalition. It does appear that it may not be that smooth, and that will play on the market. I mean, that we know. I mean, from a limited lens of stock markets, one can assume that 2019 may be a little bit more problematic than 2014 was. So yes, that's one of the other factors that will build up as a concern on our stock markets as the year progresses. The other thing, of course, is we don't even know whether it's 2019 or even 2018, as the buzz that we hear is it could probably happen this year itself. So, you know, those things are fairly near term. I mean, a year is not that long a time, or even 6 months, not that long a time. So the market is kind of a little worried about that aspect as well.
Oh, yes. And of course, Shankar, as we've seen in the past, it matters only for a few days and then we move on, whether it's UPA, NDA, the market has moved on as long as, you know, there's a clear majority. You know, you have been on record saying Indian small caps is the best asset class in the world. So right now, there's no danger to that thesis because we have seen a sharper mid-cap and small-cap correction, and the fear is that it may impact equity inflows, especially from the mutual funds and from the domestic, you know, households.
Anuj, you know, I've spent the last month or so speaking to various companies, you know, that, you know, we are interested in, we have interest in. Almost across the board, I mean, FY19 numbers look absolutely in the bag for practically all of them, where you're looking at, you know, earnings growth of 30%, 50%, even 150%, and that makes the valuations not very demanding. Now, my learning in markets is only this, that when you have market corrections like the kind that we have seen, and I've lived through in my 25, 30 years, God knows, you know, 200 of such things, when a move like this happens, you just need to go back again to fundamentals, remove technicals for a minute, come back to fundamentals. Stock prices are down 30% or 40%, 35%. If balance sheets are in good shape and if the earnings number are still intact, then they represent no-brainer buying opportunities. I mean, that's been my central learning. So, and that's a very simplified learning, but it has really worked over the years. So, I mean, all the companies that I've spoken to, stock prices are down 30%, numbers look intact, balance sheets are in good shape. I mean, I think it's a no-brainer to go out and buy those companies without any doubt at all. And I'm sure, I mean, my universe is not as large as many people's universe. I'm sure the same story is there in dozens and dozens of small cap companies where, you know, they're all doing very well. They're unaffected by the worsening macros of India. And that's one of the reasons why I've liked small caps, apart from their micros, that the macros don't affect the small caps. I mean, interest rate rise or inflation rise, you know, they will affect the big ones, the big players like Larsen or like the banks, etc. But a small company doing some small business, small part of India, they are really unaffected by all this. Okay. So, I mean, my view is this correction for the companies that have their earnings growth intact, you know, it's a no-brainer opportunity by way of buying.
Okay, you know, some of the PSU banks have also become mid and small caps, Shankar. How do you approach them? You just write them off, say, okay, I'm not looking at them, or is there an opportunity in this whole mess?
There could be, but I mean, I'm not a big fan of banking or you know, businesses which require giving credit to people and then you go chasing after them to return, you know, get your monies returned to you. I mean, I think there are easier ways to make money in life than to do this. So, you know, NBFC or banking, etc., etc. You know, there are a few exceptions here and there, like IndusInd or HDFC Bank, which we have liked. But broadly, as a category, my view is that there are, you know, I buy peace of mind apart from buying equity, and there's easier ways to make money. So, PSU banks are problematic. We all know that. But the real problem, in my view, is happening post the Nirav Modi scam. There is, and I've spoken to bankers, spoken to companies. It's a weird situation wherein we don't have credit growth. Companies on the one hand are scared to expand. Banks on the other hand are scared to lend. And this whole turning the screws on every loan above 50 crores to be scrutinized by some investigative agency, etc. I mean, government might have some logic for doing that, but my view is only that the behavior of bankers will then will turn contrary to what you really want to do, which is that you have to encourage some degree of risk taking to